Welcome to the Daily Update. This is being prepared Thursday, April 28th, where we'll look at the action in the markets today and then see how things look for Friday, April 29th. And I'm trying out a new format. There's some things that I want to go through pretty quick, and the structure will be just a little bit different. I'm trying out some new things every day. What I do a lot of times when I prepare videos is I use PowerPoint, but I like to do more of a presentation type of thing where I would just take the whole slide and then use a graphic of that to show you. What I'd like to do is just do it line by line. Some of the slides that I make lend themselves to that, but I am restructuring the format of the videos. A lot of you already know that listened to yesterday's video, and I'm just going through that. And I really want to appreciate the feedback. You guys are just amazing. You said some really nice things. You had some good ideas, some things that I do plan on incorporating. The folks that emailed me, I haven't had a chance yet to respond back to you, but the comments left on YouTube were just wonderful. And if you have any ideas, anything you want to interject, I'm always open to that. Over the years, as an educator, on all different levels, I've taught really high-tech things. I'm a Microsoft certified trainer, and right now I'm teaching the ABCs to Chinese children. A lot of the ideas that I've implemented in how I teach originated from people that were receiving instruction from me. I don't really want to call them students, but sometimes that's what they are. And that's what I really like. Sometimes there are things that I can try, and I'm like, it doesn't really fit what I'm trying to do here. Or, wow, this is really cool. Or just anything. I'm always open to trying new things. This is going to sound a little strange, but one of the ways that I feel I've been a fairly effective instructor in a lot of different areas, whether it's history, computers, economics, the stock market, political science, blah, blah, all that stuff, is I break the rules. I went to school to learn how to be a teacher, and then I said, okay, I'm picking up a few things here and there. But by the time I got out, I'm like, okay, that's how not to do it. And that's why I'm teaching the way that I'm doing right now. I used to be in a classroom. I used to instruct people of all ages and all skill levels, and I kind of wanted to do things my own way. And I'm a little bit rebellious in that regard, but hopefully rebellious in a good way, not in a crazy way. What I've kind of settled on right now is there'll be one video instead of two. I'll try to make it shorter. There'll be fewer charts. Sometimes there might even be a little more charts, but there'll be different charts than what I've been showing you. I'm really trying to pack this full of information, especially the charts that are repetitive or inverted. Yeah, a few of you said, we get that. Why do we have to see two charts just showing us mirror images? I want to make those charts available to you, and I look at those charts because sometimes we get a little bit of different insight by looking at something a little different way. But I can also see where just going through those for each video is not necessarily the best way to do things. I'm also working to make the charts available for viewing, even those that aren't used in the video. Whether I upload those to my blog or to my website or to both, that's one thing. I still want to have it so you have access to the charts. You can go look at them. And that's going to take me a little bit of time to put that together. Not that it's really all that complicated, but I just need the time to be able to do that. If you have ever done any web design yourself, and I taught classes on Dreamweaver, and I'm a certified internet webmaster, that doesn't mean anything now because I've been out of the game for a few years and everything has changed. The blog that I have is built using WordPress, and if you talk to me for more than 2 or 3 minutes, there's very few times in my life I use the word hate. I downright hate WordPress. And you've got all these plugins and all these, you're spending all this time troubleshooting, and you solve one problem only to create 4 more. And so anyway, all right. So it can take me some time to do that, is really what I'm getting at. If you are already a stockcharts.com member, or if you become a member in the future, the list that I have, I can share that with you so you can view those same things on your desktop or on your whatever you use to look at charts. So that is one thing that is available to us, but you have to be a member. And this is a little out of order at the very top. Thank you for all your feedback. Okay. And one thing that I do want to mention is I don't go through right now and put subtitles in the video. Do you want me to do that? Is that something that is very helpful to you? Yeah, it helps the SEO and YouTube likes that and everything. It takes me some extra time, and it probably would prevent me from adding the subtitles right when I upload the video, because I want to get it uploaded, then do the subtitles later, and that can take some time each day as well. Not only in English. I look at the statistics of where all of you are from that watch these videos, and not all of you are from the US. There are people from all over the world watching these videos. Would it help you if I was to try to make subtitles available in your native language? And that would just, if that'll help you, then I would be more than willing to do that. But let me know about that. Or do I just keep plugging ahead in English? Whatever's best for you. And then also, if there are some specific charts to include, for example, the Elder Impulse System, I include those charts because I was requested to include those charts. Sometimes they're used, sometimes they're not used, but I include those based on a request. And then if you want to contact me, email is the best way. And I did hear from a lot of you yesterday, and I'm very humbled by that. And I really appreciate your feedback as well. So let's go back and then just do a recap of what happened on Thursday. At the open, we did have a gap higher. We were able to get back above R1 pretty much right off the bat at about 42.29. Then we retraced down to the daily pivot. We didn't get to the unchanged level. It looked like we might be doing that, but the daily pivot actually acted as a good retrace point after the open, and that was at about 41.96. Then as the day went on, we found support at that pivot level, and then prices advanced to above R2, which was at about 42.74. And then 4,300, we actually tried to get above that, but that acted as resistance. Then coming into the close, there was minimal late day selling, just a little bit. People that are day traders, people that have a lot of positions, they like that we had a good bounce. And so they're just closing things out. We closed just off the high, and we ended up being up 2.47%. That's a pretty big move. That's a big intraday move. But we've been seeing a lot of that lately through the real volatile markets in 2022. Volume was above average, so that kind of helped things as well. And then we're still looking at the technicals. Yes, they're improving on a short-term basis, even a little bit on an intermediate-term basis, but they're still negative overall. Then we have all the different things: inflation, interest rates, geopolitical concerns, earnings, which really seem to help the markets on Thursday. And so we just kind of take this day by day. Then, as far as some comments to make, the longer-term maturity interest rates advanced. These are the 5, 10, 30-year, and I think even the 2-year, advanced as far as interest rates. The yields, that means the prices went down and the interest rates went up and stocks went up. And that's what we've been seeing this week. Interest rates and stocks have been going in the same direction, which, as I stated yesterday, it was the complete opposite of that, which got us into this situation that we're in right now. Then there was a strong advance led by growth stocks, and some of the earnings reports came out, especially Facebook. They seem to have a good earnings report, and everybody liked that. And I don't know why they're drawing up here all weird. I have to go back through and fix the presentation mode or my timing. But the the equity put-call ratio is still quite high, and I'll show you a chart of that. The technicals are still negative but improving. Can this continue? As I record this, the markets are down a little bit, about 0.25% in the overnight session. And then we were able to regain that intermediate term support level at about 42.76. Breadth is improving. That was one of my complaints about yesterday, was that we saw an up day, but we saw declining issues in volume outpacing advancing issues in volume. That was more in line with what we saw on Thursday. The S&P is still in correction territory. We're still just above 10%, the way that I calculate it. And we did bounce out of an short-term oversold condition. And then this is it here again, folks. The 10 to the 5 is back to being inverted. Just by 0.01, but it is inverted right now. The economic reports that came out, this was really a big report that kind of got just lost. The advanced GDP shows that we have an annual rate decline of 1.4%. which may suggest stagflation, because we're seeing the deflator inside really high, and we're seeing GDP really going negative. Now, the definition of a recession is when we have negative GDP for 2 quarters in a row. This is the advanced report. We'll have the final report coming out later, and we'll just have to see if there's any adjustments made to that. But when we see really high inflation, yet the GDP being in a recession, that is what we call stagflation. And that's what we saw back in the 70s. And it is not a fun thing to be a part of that. The trend condition now is negative because the ADX is above, and this bottom part's going to get a little chopped off. I'll try to adjust that. The trend is negative. Our bias is positive because we had an up day. I switched that back over. But our momentum is anywhere from mixed to negative right now. Then some other things that I'm trying to add is just some technical overviews. And I'll go through these kind of quickly. Instead of showing you all the charts, I'm just going to go through and mention some of these. Where growth is underperforming value, even though growth had a good day, overall it's still underperforming. Growth is outperforming bond prices. Yeah. Energy is outperforming the S&P right now, or the SPY if you trade the ETF. Tech is underperforming interest rates and as well as stocks. The CRB is outperforming stocks right now. Gold is outperforming stocks. Rising interest rates are outperforming stocks. Momentum indicators are still negative. I'm not going to show a chart, but that whole list of all the different oscillators that we look at, they're still negative overall. The moving averages are improving, but we're still below all of the moving averages. The new highs and new lows, they're still declining overall. Discretionary is underperforming staples. Discretionary things you don't have to have. And in a good, healthy environment, a good, healthy economy, that's when you go out and splurge and buy some toys, buy some things that you like to buy. Where staples are the things that you have to have. Well, since we're seeing a slowdown, people are cutting back on the luxury items and just focusing more on the can I get food at my local grocery store. The long-term trend is still declining. There's no changes in the chart variations. The 3-line break, the KEGI, the Renko, the point and figure, so I'm not going to include all of those, but they're all still negative overall. And then the world indexes continue to decline, and I think I'm near the bottom here. Junk bonds are outperforming treasury bonds. People are seeking that yield. You get more of a return on a junk bond, but you're also taking on more risk. So let's go back and look at the day's session. First, we'll look at sentiment. And I don't know what to think of this. It says that we're unchanged from the previous. We were down into the 28s. I don't know. But anyway, we're at 38 right now, according to this chart. And then looking at the longer term view, we've gone up a little bit. I'm just finding this not to be very accurate right now. The VIX did decline, both on a closing basis and with the bar chart. We closed about in the middle of the bar overall on the VIX. And then this will be the last time I show this unless we really spike up. But the RSI is now coming back after giving us an extreme fear reading according to the VIX. Then the Ulcer Index continues to advance, so there's still quite a bit of fear out there. And then we had the American Association of Individual Investors. They came out, this is the lowest reading we've seen in an awful long time. They are very, very bearish, which we use that as a contrary indicator. So that could be helping produce some of the bounce. Then we also got the Retraced ratio, which increased a little bit, which means people are getting a little bit more fearful that invest in the bearish Retraced mutual funds. Then our NAAIM number came out. These are asset managers who are actively managing their portfolios. This goes over the last week, including the big down days that we had, and it shows that they are really decreasing their exposure to risk. And we've been down at about this level before we turned and went back the other way. The equity put call ratio, this is a 1 day shot of this. It's still pretty high. Yeah, it declined after really spiking, but it's up there. Pretty high. And then here's a 5 day simple moving average where it spiked up and it just rolled over just a little bit. So we're still showing that there's a lot of fear in the market, which could be positive for the market right now. As far as our sectors, every one of them was positive, with communication, which has just been getting hammered. It was up the most. Tech, energy bounced back. Everything was up pretty strong. At least 1%, 2%, 3%, 4%. So good solid day across the board. And here's just our sector view, with energy doing the best since the all-time high, utilities, staples. These are more the value plays. Then, even though we saw a bounce, communication, discretionary, tech, financials are having a little more struggle too. But these are the areas that have really underperformed. And these are the areas where, when these areas are going up, that's when we hit new highs. That's when the Dow, the S&P, the NASDAQ, that's when they're shooting up day after day after day. And with these underperforming the way they have, that's why we're seeing this choppy environment that we've been seeing all year. Now, FedWatch, I'll go through this really quick. There's a 96.5% chance that we will be at 0.75% to 1% at next week's meeting. Here's the historical chart. Here's a look at the June meeting, 84.1% that will be at 1.5 to 1.75. Here's the historical chart. The July meeting that will be at 2 to 2.25 is at 79.4%. So they're jockeying around each day. And here's the historical chart for this. Our technical alerts, a lot of them were really positive. I'll just focus more on the S&P, where we got back above 4,200. We tried to get back above 4,300 here, but we just were not able to maintain that. The euro is really declining against the dollar, and it set a new 4-year low. The dollar set another 2-year high. Oil got back above 105, and then there's a lot of the sectors and the NASDAQ that really saw some strength. So we're seeing a lot of positive technical alerts right now. Here, intraday, here's where we gapped up right at the open to above R1. We came back down, and then we hit the pivot level. We didn't quite go negative with the S&P. A few of the other indexes did. I'm like, oh, great, all right, here we go. Well, we were able to bounce up off of that. We broke back through R1, shot up to R2, got up to 4,300, and then trailed off a little bit going into the close. So it's kind of what you would expect with an oversold, a lot of fear-based market right now. Then we got back above this intermediate term support. So that can be considered positive as well. And we were above average on the volume. We're down 10.61% currently from the all-time high. Our trend, it's kind of going flat, even though it's above 20. So we are still in a trending environment because the red line's on top. So you still might want to base things around a trend-based strategy. But if we keep going up from here, this red line is going to come down and we could drop back below 20. So be aware of that. Our Arun is showing a little bit of a decrease in selling, but also a decrease in buyers. So our oscillator continues to decline overall. Then looking at some breadth, this is the advanced decline ratio just based on 1 day. And this shows a big improvement over what we saw. Where yesterday we were down in this area. Well, now we're back up into this area. So that's a pretty big move. And this is what I want to point out. I've used this chart a lot over the last few days where we were extreme negative after shooting down Thursday and Friday last week. Well, we shot up so far. Maybe we've gone up a little too far, too fast, based on Wednesday to Thursday's session. Here's looking back at 5-point rate of change coming out of an extreme negative condition. 10 period also not really extreme, but still dropped below this level and is recuperating a bit. 20 period coming out of an extreme negative reading. Our Fibonacci, we're getting back above the 50% retracement level based from the low to the all-time high that I got back from last fall in 2021. Then standard deviation, we're getting kind of far away from the standard price or what the price should be. And this goes back 10 periods and measures that and then sees how far away are we from that. Then our stochastics, we're showing a bit of an improvement in the short term. We're bouncing out of an oversold condition. We're still extreme negative intermediate term. We're still declining with the longer term stochastics. Then our trading systems, the elders, S&P has switched back to neutral. SPY is neutral. The SAR continues to be negative. It hangs in there longer. Then some long-term things to look at. We're still below the 200-day moving average. Some other things to look at. The diamonds are back to neutral, as are the Qs. Then some other things, too, is the dollar. Man, look at this. It's almost going parabolic here. So don't be surprised if we see some kind of a pullback in the dollar. It's just going to the moon. They said in something I was reading that this is like a 20-year high in the dollar. I just do this on a closing basis. So, yeah, you could say maybe we haven't been this high in quite a while. And that could really pressure stocks at some point because of the exchange rate. And it doesn't make our imports and exports as attractive to other countries, and it might make us have to pay more to get things from other countries as well. So at some point, this may turn more negative, but it's also nice to have a good solid currency, even though it's a fiat currency. We're looking at a real decline still in the Japanese yen. We're looking at a decline in the euro as we see an advance in the dollar. Oil got up to 105. 105.36. Here's some intermarket analysis. This just goes back to the beginning of the year and shows how things have performed. Oil has done the best this year. The dollar has actually crossed above gold for its return going back to the beginning of the year. The S&P is bouncing a little bit, but is really underperforming, as is the price of bonds overall. Speaking of bonds, here is the inverted yield curve, minus 0.01 right now, but it's still inverted. And the 10 to the 5 is not one that people really consider to be that important. I just put it on here and go, okay. Now, you may disregard this and say, no, that's not a very good way to use the yield curve. You're too close in your maturities there. That's fine. Then there's another site that I go to, and I haven't included a lot of their charts, but it's IsabelNet, I think that's how you say that, .com, and it's a blog that you can go to. There's a paid part of that site. I don't belong to that. They have a blog, and they post things every day that you can go and look at, and I'm going to start including some of those. There's a few that don't really apply to what we're trying to talk about, but some of the charts can be useful. Where this is just showing a 5-day moving average of NYSE stocks, that's the New York Stock Exchange, and a 5-day moving average of advancing volume in the NYSE on the daily chart. And it's showing some divergences here, where we were going down in price in September. Well, we were showing a positive divergence based on advancing stocks and based on advancing volume. That's what we look for. Then here, they've set up at the 42.22 level. And these are just some lows that we've hit. We are seeing a positive divergence in volume. And there's some videos that I watched that are also pointing this out. There's something in me that doesn't like to take NYSE information and apply it to the S&P 500. So I'm a little reluctant to do that. I want S&P information on the S&P. Still, the NYSE is a good broad measure anyway. And we're also seeing a positive divergence based on volume. So this could potentially bode well for prices going higher. Another chart, this is Goldman Sachs. This is their forecast. These little red dots here, this is what they're thinking the markets will be in the future, that we're going to go higher from here. This is the probability of a recession beginning within 12 months. This is put out by JP Morgan, where based on the economic indicators, that's the blue line, they're at about 9.4% probability that we'll hit a recession. So that's what, almost 91% that we won't. Based on the yield curve, 8.7%, so what, 92% that we won't. Based on the S&P and the BBB spread, I'm not quite sure what the BBB spread is. I'll have to look that up. It's a little bit higher at about 40%, but nobody really knows these things. But if we get a GDP number as the final number like we just got, we just need another quarter of that and we will be in a recession. Here's another one, the total returns. And this goes back, my gosh, like 1900, long time ago. And this just shows the valuations that we were at. This is before the 1929 crash where we peaked out. This is the dot-com top, and then we crashed after that. Well, right now, we're at 37.77. So have we topped out here? We don't really know. But we are at quite highly elevated levels on a valuation basis. Then another thing that comes out is the St. Louis Fed Financial Stress Index. Just, are the banks going to freak out? Is the financial system in danger of breaking down? Well, look at this over here. We're really, really dropping off. Now, this can change quickly, but look how it spiked up during the COVID plunge. Look at how it spiked up during the financial crisis. Look how it spiked up after 9/11 and the whole dot-com bust. But we're not spiking up right now. Then this is one that we get every quarter. This is the velocity of money. This is how money is moving around. All the trillions of dollars that they've been throwing into the markets, it's not even really moving yet. I've been waiting a long time for this number because we didn't get this before like last September. And you're just looking at this, waiting for this to be updated. And this really didn't move all that much. And then this just shows the financial conditions, the Chicago Conditions Index. As long as we're below this black line, it doesn't really suggest that we're in any kind of economic trouble. So we're seeing some contradictions right now. A GDP that could be declining. And again, that could be in a recession. But we're seeing a lot of these other indexes not really reflect that yet. I want to include some charts based on the potential scenarios. Now, it doesn't mean these are going to happen. These are just things that are on the back burner that I've been talking about here. And I'm saying I've got some indicators that are starting to show that something might be happening. One is the Kopic curve, and this is pretty good at finding market bottoms. It's not very good at finding market tops, and not every signal here is legitimate. We found a really good signal here in the middle of March where we turned back up and really spiked up, and then that took prices higher. We're still declining, but if you looked at it on a little shorter term chart, it's turning up ever so slightly on here. So we're just keeping an eye on that. We're watching for the cross that has not happened yet. Then here's the mass index, which I brought up in the past. If this goes above 27 and then drops below 26.5, that's an official signal, and sometimes that marks some kind of a move in the market. Now, it doesn't tell us the direction. It just suggests that some kind of move is going to happen at that point. That's another possible scenario. Here's the one that I'm kind of noticing a little quicker. This is the Pring Bottom Fisher. Again, it's not very good for finding market tops. It's pretty good at finding market bottoms. It helped us out really nicely in the middle of March. It's getting close to crossing over. But it's not always right, and sometimes there's a lag time. We get a signal, and then we can wait a little bit of time for that. We can't rely on any one of these. We have to use the whole picture together to come to our conclusions. At least that's my view on things. And then the other one is the Staples to S&P 500 ratio. Well, we continue, even though we declined a little bit on Thursday, we're We don't know if this is a spike or not. And again, at other times, when this is spiked and headed back down, this has marked some kind of a bottom in the S&P 500. So we're waiting to see if that will happen. Then another one, I haven't shown this in a while. This is the 2-year Treasury yield. When it spikes, and this one you got to be kind of quick on, because when it spikes, we see kind of a real short-term thrust. And then right after that, dot-com bust. A spike, a little bit of a thrust going up, and then the financial crisis. A spike up and down. We saw a really nice run up right before that, and then we had the 2018 Christmas Eve mini meltdown. We're waiting to see. It never did spike up during the COVID plunge. It didn't really have time to do that. But we're still going higher with this chart. So this is just another thing that we kind of want to keep an eye on. Another potential long-term scenario, and again, when I say scenario, this is just a thesis. This is not even a thesis. It's a hypothesis. This is kind of the running scenario that I've been going with. And I'll share that with you. It doesn't mean this is what's going to happen. I just see things lining up right now that could make this happen. This is longer term. Where, first of all, I see us potentially having one more strong thrust up in the S&P, which could very well likely set a new all-time high. We get up there, everybody's thinking, oh, the wonderful stock market, we love that. Well, right before that, it could be very powerful, but it may not last very long. Then if the U.S. enters a recession or has some kind of economic problem, I see us after this whole thing plays itself out, of going into a sharp long-term bear market. Now, I'm not a doom and gloomer, but we're due for some kind of a bear market. And the doom and gloomers, of course, every day is the end of the world to them. I'm looking at things, I see things that suggest that we could go higher, and then once we just kind of blow off the top, then the market gets set, and then we enter into a multi-year bear market. Now, am I right about that? I don't know. We'll have to just see. But that's the scenario that I'm looking at right now. And that could change. So what's our outlook then for Friday? The technicals are negative but improving. The markets remain trendless. The growth and value battle continues. The supply chain issues are still there. Economic reports, we have personal income and spending, PCE prices, the first quarter employment cost index, the Chicago PMI, and then we have the final consumer sentiment reading. Then all the different geopolitical events, Russia, Ukraine, China, inflation, oil, earnings, Fed speak, Japan, which I've just recently added to this list. And then here's the different scenarios. For us to continue to go down, rising interest rates and inflation fears, and I put a question mark there, because it's like, wait a minute, this whole week we've been going lockstep with interest rates. There's something weird going on there. But earnings reports that the market doesn't like, or some kind of Fed speak, that could drive things lower. The real positive, or the real powerful part of this is the technicals. They are still negative, even after the bounce. But the short term is improving. For us to be positive from here, can the bounce continue? That's question number one. And this is just a statement of all the scenarios that I just went through right here. And then the technicals, yeah, we need to see a lot more improvement than what we're seeing now for us to go up from here. And then the sideways, which really is not a viable scenario right now unless we drop back under 20 with the ADX and we drop below the moving average. Will it fall if there is a rebound? We saw it go sideways a little bit on Thursday. If we keep going up from here, what's that going to do to the ADX? So our conclusion then is the S&P is still negative overall. Short term, it's negative but rebounding after being oversold. We have to kind of see this as a dead cat bounce at this point. Now, if it feeds into itself and we start to show some consistent strength, it's not a dead cat bounce. It could be an actual rebound. We don't know that quite yet because our intermediate term is still negative and possibly doing some rebounding after being oversold. And then long term, we continue to be negative because we're below the 200-day simple moving average. There are some different resources that I just want to point out to you. And some of these are YouTube channels that aren't even mine. I go watch videos from these folks. Some of you, I've recommended these to you before. Some of you like them, some of you don't. So it's up to you. One of the things that I like to do as an educator is I promise that I won't hold anything back. If somebody else has good information and it's not me, I have no problem sending you there. My goal is to have you become educated, even if there are times when I'm not the main part of that. Stockcharts.com, that's where I get my charts from. I used to use some software a long time ago, but the charts that it creates look so ugly that I just stopped doing that. If you do end up joining stockcharts.com, there's a place to put a referral. If you stick, and then I even spelled this wrong. It should be SPX investing at gmail.com. I get like an extra month if you join for a while. So that can just help keep my costs down a little bit. The isabelnet.com that I just showed some charts from, Edward Yardeni. I really like reading his stuff. Also, he has a YouTube channel, and I would recommend that. There's another YouTube channel called Pensioncraft. The gentleman is based out of England. Actually had a few exchanges back and forth. Really nice guy, but does things from more of a UK perspective. Game of Trades, some of you might be familiar with that. Really good analysis that they do. And then I can't even begin to... Ciavaco? Capital. About once a week they come out with a video. I like to watch it. I've found some useful insight from that, and I just wanted to pass that on to you as well. So thank you. Have a wonderful Friday. I'll prepare another video after Friday's session, and then I like one of the ideas that somebody came up with where maybe I just do one really longer video during maybe once a week where I do go through all the charts. But then the other times I'm just picking out the charts that are actually telling us something. So have a great Friday, and we'll talk to you in the next video.